Good morning, everybody. My name is Jonathan Levin. I am a columnist with Bloomberg Opinion, and we are here to talk about CPI Day, the nation's inflation data coming down the pike in about 5 minutes. I'm here with John Leer, chief economist with Morning Consult, as well as my colleague Allison Schrager, a Bloomberg Opinion columnist and senior fellow at the Manhattan Institute. Here's the deal. In just about 5 minutes, we are looking for CPI. The street's expectation is that the month-on-month figure, seasonally adjusted, would have gone up 0.1%. The core, which is what your monetary policymakers are laser focused on, would have increased 0.2%. And to give you that on the year-on-year figures, you're looking at 3.1% potentially on headline and 3.4% on the X food and energy, the core. Why is this important today? Well, we're looking to see if we can reestablish a trend. We had some pretty encouraging inflation dynamics in late 2023. Everybody got all bulled up about it. We said rate cuts are coming, and then our hearts were broken in the first quarter. We got some rocky data. Some folks would say a lot of it was noise. Others would say, you have to be very careful, ignoring the data. But since then, we've been sort of back on track for 2 months. And this number could sort of reestablish that trend. So, John, let me kick it over to you. With the 3 minutes we have before we get the numbers, what are the stakes here for you?
The stakes are really high. You mentioned up top that, I think the Federal Reserve is going to be watching this data point really, really closely. My expectation is that inflation will continue to cool this month. We see that a smaller share of consumers are surprised by prices when they go to make a purchase. And that historically has been a really strong predictor of CPI inflation.
Yeah, for sure. What do you think, Allison? I just want to point out we had Fed Chair Jerome Powell on the tape earlier this week. He said he's still looking for "quote unquote" greater confidence that inflation is moving sustainably toward the Fed's 2% objective before he were to, seriously think about pulling the trigger on a rate cut. What does greater confidence mean to you?
Probably, as I said, this will go a long way to inspiring greater confidence in him. I think what happens today will really determine whether or not certainly a September rate cut is on the table. Now, maybe not guaranteed, but certainly a possibility. Because as you put it up before, this sort of establishes a trend of inflation improving, and maybe we can just put what happened earlier in the year as just sort of just a little hiccup. Maybe a little noise, and maybe we are sort of heading towards at least a more sustainable, lower inflation number.
Sure. And one thing I do want to underscore going into this number, we always spend a bit of time here looking at the decomposition of inflation, and we'll do the same exercise again today. Some folks, I would say a significant number of the sell side economists that forecast this thing out to the decimal point, suspect that the housing component, primary rents and owner's equivalent rent, might start to seriously soften in earnest this month. And if that were to happen, this is a massive chunk of core CPI, and that alone could do a great deal toward putting us back on track. And it would also shore up confidence in a big way because it's such an inertial category, right? This is not something that bounces around from month to month. It's one of these imputed categories. And so when it starts to move in a direction that you like, you can have a decent degree of confidence that it's going to continue to move in that direction for a little while. So we're gonna take a close look at the shelter component. But first and foremost, we're going to be looking at those headline numbers that should be coming out in just a moment. So I'm just going to wait for that to populate, and boom! Oh, America, we are back. Yes. we get CPI month on month down 0.1%, seasonally adjusted month on month. Your core goes up just 0.1%. That was less than the consensus forecast of 0.2%. Year on year, that leaves your June CPI up 3% from the previous June, and then your core is up 3.3% from the same period a year ago. Hey, this is the right kind of surprise, Allison. What do you think? You've been here with me on these broadcasts on some really, really bad days, but this is definitely not one of them.
Yeah, I mean, it's good news. And in some ways, I mean, I guess, we haven't fully gone through the decomposition, but just looking at it, a lot of it's coming from lower energy prices, which we've been seeing. So while I'm excited about the report overall, I mean, that is a little worrying because energy prices can be somewhat volatile, but there's no doubt that this is a really good report. And I said, certainly, I mean, I've been skeptical there could be a rate cut this year at all. And now I definitely think, I'm feeling much more optimistic there'll be at least one, maybe two.
Sure. John, what about you?
First reaction, I mean, this is, I think, objectively good news for the economy. It's important, I think, to contextualize it. And so what we're seeing here is that inflation is essentially leveled off month over month. You pair that with a cooling jobs picture, although, again, still pretty tight, and then maybe a cooling consumer and demand outlook. All of a sudden, that looks like an economy where economic activity is coming back into balance. But Allison is right, I think, to go through and start looking at the different line items, because it does look like it's being sort of disproportionately driven by a few categories.
Okay, we're gonna go there in a second. First things first, I want to give folks here. You can see that up on the screen, right? This is your intraday chart of the yield on the 2-year U.S. Treasury. Everybody see that all right? Hello?
Crystal clear.
Yeah.
Okay, good. So this is very, very meaningful for U.S. markets. We headed into this number. We were as high as 4.64%. We drop the sort of knee-jerk reaction took us right down to 4.5%. We're bouncing around a little bit as the market and the computers figure out what we're doing here. But this is a massive reaction. We are no strangers to massive reactions here on the CPI Day live stream, but this is definitely one of the bigger ones. Okay. Let's see here. Let me back up here and just put this question to you as I pull up the decomposition. So what is a trend? As I said in the introduction, Jay Powell says he wants greater confidence that inflation is coming down. The Fed has a dual mandate. It's also worried about full employment. The labor market seems to be slowing, weakening a little bit. Unemployment is objectively creeping up, although we can have a very interesting discussion about why that is. A lot of that is just, entrance and re-entrance, not a bunch of people getting fired. This now constitutes the third straight good report. Is 3 a trend in monetary policy land, John?
I love how direct that question was. I think in this instance it is, and I would caveat that slightly by sort of contextualizing the data, right? So to try to get that sort of noise signal decomposition, there's a couple ways you could do it. One would be to look strictly at this data set in isolation. The other would be to contextualize it, which is my approach here. And it's kind of what you just described. I think when we had months where inflation peaked and we saw really robust consumer spending. That to me was a sign that the sort of demand was still outpacing supply. It doesn't feel like that's where we are right now. It does feel like there are real pockets of weakness on the consumer front, and we're seeing that now sort of manifest itself in terms of weaker demand relative to supply, and as a result, lower inflation. Having said all that, it's a good caveat. Having said all that, 3 months at 3+% year-on-year core CPI is nowhere near the Fed's 2% core PCE target. And so I think it is sort of premature at this point to say that we've won the battle against inflation, but we're seeing some really positive dynamics.
Yeah, sure. I'll send it over to you, Allison. I'm still fumbling around my decomposition, so you'll have to bear with me. But I will update you with this. A couple of things I'm noticing just off the BLS press release. So shelter, that all important inertial shelter category, does slow meaningfully. That is a big part of this story. So you were going along at a 0.4 clip for much of say the past 6 months in shelter. You now drop down to a 0.2%. Even within shelter, it's important to look even closer at the decomposition. But again, this is kind of an inertial category. So once you get that rollover, I think most of us hope it means that you're going to continue to see that as a sort of a tailwind for the dovish story for a little while. Allison, is this a sustainable trend to you?
Well, parts of it are. I think, certainly we're seeing the things that were certainly the canary in the coal mine before, like used cars as well. There's also been a lot of improvement there. A lot, and as I said, shelter, as I said, is a very sticky one. So that's a good trend. I think what worries me overall about this, and I don't want to say worry almost because I think this is a great inflation report. And even, as I said, core is looking really positive. But I am concerned that so much of the deflation is coming from energy, which suggests that a lot of this, certainly the deflation we're seeing, is coming from a supply shock more than slowing of demand. And that just, to me, feels less sustainable. But I mean, I don't want to throw too much water on this because even when you do look at the core number, which excludes the energy sort of deflationary pressure, you still have a very good report. Even if it is still higher than what the Fed would like, it is definitely a big improvement.
Yeah, and to give folks an idea, certainly energy is a component here, and let's not kid ourselves. Energy feeds into a lot of other things, even sneakily into the core, right? In different ways. But the big stuff that has really pushed around this index over the past 2 or 3 years, used cars and trucks, again, coming down in a meaningful way in June, down 1.5% month on month. New cars as well. You're just seeing a lot more discounting on dealer lots. And so, at down 0.2%, you're talking about basically flat, but, we were down even more sharply the 2 previous months on new cars. Medical care services kind of muted. That's measured differently in the PCE, which is the Fed's main gauge. So we're going to have to wait for PPI tomorrow to learn a little bit more about the trajectory there. But this is this is looking pretty broad based. A slightly smaller category that I've looked to at times as kind of a canary in the coal mine, apparel. Like basically doing fine. There was this weird up 1.2% month on apparel earlier in the year. Apparel's basically flat, give or take, on the month. Broad-based cooling here in this thing. Let's though talk for just a second about the dual mandate, because this does come on the back of some unemployment numbers that have been concerning to some, confusing to many, I would say. The labor market had been demonstrably on fire in 2023. It was still pretty warm in early 2024. Um, at first people said this cannot be. This is not consistent with disinflation, but then it was, and we learned there were some interesting elements going on under the surface that we didn't initially understand, like additional labor supply from a sort of an immigration shock, and here we have cooling, and people always worry that when cooling starts in the labor market, at some point it's going to snowball in an alarming fashion, and unemployment is one day going to get out of control. We're going to wake up one week and those initial claims are going to be through the roof, and it's going to be too late for monetary policy makers. What do you make of that, John?
I think that's right, almost by design. I mean, monetary policy is a blunt instrument. There's a reason that folks who have been on your program before, like Claudia Salm and others, advocate so strongly for automatic stabilizers to come back in at times when, when it is too late for monetary policy to cool things off or to help folks who are in need. My concern, I think, is that there's a narrative out there that the Fed should essentially take their foot off the brakes now because we are trending in the right direction. And I just would say trending in the right direction is not nearly the same as being where you need to be. And I would go back to what we saw in the UK with the Bank of England kind of taking a slight change in its communication, previously signaling a rate cut and then walking away from it. That is not the game that the Fed wants to play, especially as it fights like hell to maintain its credibility and is moving into another period of review of its monetary policy strategy. So I don't think this is going to be an about face from Fed policymakers because of one data point.
Yeah, I also on that. I think that also assumes that monetary policy is very contractionary, which I think is debatable. I mean, considering, if interest rates were at 8-10%, I'm like, yeah, that could cause a lot of damage and bring on a lot of inflation. But I think it's debatable that even at the rates they're at, as high as they've been compared to what we're used to, it's not clear that they're super contractionary. In fact, I think the Torsten Slocks of the world even argue they might even be expansionary now with their language right. So, I don't think rates where they are going to cause a lot of damage to the labor market. You can make an argument that maybe they should be 100 basis points lower or whatever, but I'm not sure it actually is going to wake up in one day the labor market's going to be a disaster, bar some external shock.
I wonder there. I think that's such a good point, because if you go look at all the financial conditions indexes, they're all still really robust. Part of that is the stock market is still just on a tear. And that is, I think, in large part driven by some of those, those top 5 or so companies. And that, I think, is the world that we live in right now. And it's true in the stock market. You've got some overperformers with a lot of sort of struggling companies. The labor market, you've got some sectors that are doing really well: government, healthcare. Everyone else is sort of languishing. Consumers, you see higher income consumers continue to spend, middle, low income consumers seeing sort of debt forbearance on the rise. That is the challenge that monetary policymakers are facing right now, which is we have an economy that is really bifurcated, and it's going to be difficult for a sort of single rate to reflect the underlying reality across all these different dimensions.
All right, for sure. And it all sort of also goes to the debate about what is restrictive, and the notion that sufficiently restrictive is always going to be very different in the short term and in the long term, right? There's this concept of R star, the neutral rate of interest, which is kind of like having your car in neutral. You're neither pushing the economy forward or trying to restrain it, but neutral can mean very different things in the short term and in the long term, especially in an economy like ours, where we have these things like the mortgage lock-in effect that we talk about, which is obviously not a permanent phenomenon, but nor is it going to, are we going to wake up tomorrow and it's completely going to disappear, right? A lot of people sort of locked in lower rates.
I mean, I wonder, one question might be, are interest rates essentially, how high do interest rates need to go to curb housing demand? And I think, that's what we've seen thus far, is that it really hasn't moved the needle, at least as we see in the inflation data. And I've said it anecdotally as well. There's a pent up demand for housing when supply is struggling to get online to meet that demand. It seems a little absurd that you would need interest rates to break the back of demand for housing to sort of get inflation to permanently roll over. I don't think that that's the goal of monetary policy. Housing affordability is a broader sort of countrywide policy perspective that it's not really as much about sort of the ebbs and flows of the business cycle.
For sure. Well, listen, let's get into the decomposition here, because I've kept everybody waiting. So what's going on this month, this month of June? I want to underscore, first and foremost, this is a point we make pretty much every month on this live stream. This is still a services story. Services are your, let me actually give folks a shorter time horizon so we can see this more clearly. So these are your core month-on-month numbers. This is the decomposition thereof, and the red bar is your contribution from core services. The blue bar is your contribution from core goods. So core services still contributing to inflation in a positive way. Core goods acting as a slight drag. This is kind of like the way it's always been. This represents, in a sense, a return to normalcy. We had years and years and years where deflation, outright deflation in core goods was kind of a normal thing. So like, what's going on, digging further under the hood? And I'm really just going to focus here on the core services component, because that's the big one. Okay, so big move here. What drove it? So again, the contribution, this is not the month-on-month change for the components. This is the contribution from each of these components. The contribution from shelter is halved, even more dramatic, the move than that. You went from contributing 24 bips those are basis points in May to just 10 in June. Okay, transportation services again is a drag. Those are things like your airline tickets and so forth. Medical care services, again, pretty muted. Again, try not to make too big a deal out of that, because the Fed really looks at a different gauge of medical care services. Recreation services, I think that's it's not a huge category, but I think it has been a decent bellwether, because it's discretionary spending in the services sector, and recreational services, again, a drag on overall core services. So everything looking pretty good. Let's dig into the contribution from shelter, because that is really as I've tried to make the case here, that is really the story this month. So here's the yellow bar shelter. What's going on here? And can we count on more of it going forward? So shelter overall, major cooling. A lot of that is coming from the drop off in rent of shelter. Rent of shelter was doing like a 0.4. Now it's doing like a 0.2. Within that, you have some funky names for categories, but names you've probably heard before at this point. Owner's equivalent rent of shelter. That's this sort of imputed category that tries to approximate the inflation theoretically experienced by people who owned their own homes, even though most of them are not actually experiencing inflation. You might say this is this theoretical number that drops in a meaningful way. And then rent of primary residence, also a slowdown there. And then lodging away from home actually is a drag this month. So I feel pretty great about this decomposition because it's the shelter thing, right? The shelter thing had been the bane of Jay Powell's existence for probably 2 years. It's an inertial category. I'm not predicting like what's going to happen with market rents and owner's equivalent rent like over a 5-year time horizon. But I think now that we've seen this thing roll over, that we can kind of count on a pretty good stretch going forward. Does that make you guys feel as good as it makes me feel?
Yeah, I'm actually even happier because rent is also forward looking. You know, when you set rent for a tenant, like you're thinking, what are my costs going to be over the next year, maybe 2 years? So it also says something nice about expectations.
Sure. John, what about you?
I guess, again, I get a little concerned that we're going to try to tackle inflation by sort of breaking the consumer and the consumer's ability, solving the housing affordability crisis essentially by pricing consumers out of the market and reducing demand there. I think one thing that I just wanted to flag, and I know we talked about it briefly before, but that goods versus services breakdown is so important right now. We as you mentioned, we sort of have been on the back of this, I'll call it a 20, 30-year tailwind to goods disinflation driven by China joining the WHO and or WTO and all the sort of globalization that occurred. It feels like we're on the precipice of sort of changing that trend, or at the very least, we've sucked as much out of the sort of disinflation as we could from globalization. And so going forward, I think there are probably some more secular headwinds on the goods front, meaning that service is going to be even more important.
Okay. All right. Fair enough. I wanted to bring you guys a question from a TikTok user watching us out there. Question is, the pace of decline seems to be slow. It's going to be 2025 until we hit 2%. John, you want to tackle that one? Should we be concerned in any way about the pace of the decline here? Meaning the pace of the disinflation?
Well, I think we got through the easy part of disinflation earlier, which was the goods disinflation. And so now we're dealing with the sort of the stickier parts of disinflation. So it's not surprising to me that the pace is slowing a little bit. I do think that folks at the Fed and others are watching that pace. And again, 3 or 3.5 is not the same as 2. 2 for a month is not the same as averaging 2. We have to figure out what averaging 2 actually means, but 3.5 is definitely not 2. And so, so I think that matters. Yeah, I would be a little concerned, I should say, if inflation rapidly bounced back to 2%. I think that would be a sign that, let's say 2 or 3 months ago, that the economy broke essentially and demand just dried up. What we're trying to figure out is a way to get the economy back into balance without breaking things. And so that's almost by design. We're sort of taking this more gradual, measured approach.
All right, fair enough. Hey, last talking point before we wrap up here. Policy tries to be forward-looking, obviously, and folks at the independent central bank in the United States of America obviously try to convey a sense of we're not political creatures, but the deal is we are in July of an election year. We are now talking in the base case about a potential rate cut in September, which would be the very last meeting before a presidential election, with a lot of moving parts at this very moment, by the way. And we have again, at the moment, two candidates who seem to be pretty pro-deficit, and one of whom seems to be really, really into tariffs, which economic orthodoxy tells us is, a tax on consumers, basically, a potential inflationary bomb. I'm sitting here kind of myopic, looking at what I think is a great inflation report on July 11th, 2024. But if you're policymakers, how much does that political uncertainty come into your decision making, John?
I don't think it can come into their decision making at all at this point. I mean, there's so much that's left open. Chair Powell and the FOMC, I think, are pretty consistent in saying they take fiscal policy as a given, and they condition on that as they make their policy announcements. I do not believe that they're taking election outcomes, particularly election outcomes in the U.S., into that optimization function. If tariffs were to come into play and all of a sudden you start to see prices increase, or the potential for prices to increase on certain goods, then I think it would be appropriate, and I would expect the Fed to start taking into account those policy decisions.
Okay, Allison, what about you? Politics?
Well, again, I mean, I think as we discussed before, both parties are very pro-tariff. And, I saw this ridiculous tweet, I think, or from some Biden officials just saying, well, our tariffs are different than Trump's tariffs, but they're all bad. And, I think a lot of the industrial policy is another sort of form of tariff. So I'm not sure if under Trump, it's really going to be that much worse. I mean, other than his, we're going to have a huge tariff on everything. I don't know if that's really even realistic. I think, again, they're both pro debt. They're both pro tariff. And honestly, I think there's just a mood in Washington that just likes using economics, and this is true of both parties, using economic policy as statecraft, which is let's do less trade with people to sort of further some political aim. And that's just inflationary. And that's just a choice that both sides have taken. So I don't know if I'd look at Trump and be like, oh, that's going to be more inflationary than the other. I think it's just, we're in that political era where this is a trade-off people want to make.
And I would just say quickly, that also just reflects the desire of the electorate right now. When we go out and survey people and ask them, what sort of economic policy do they want? They are largely protectionist in a way that they weren't a couple of years ago. And I think we see that with, Biden didn't even think about removing the tariffs on China, 4 years in. Now, how we go about actually implementing some of these tariffs and some of the currency wars that I think have been challenged are, there's some implementation questions out there, but the net result, I think, will ultimately be more protectionism, more geopolitical uncertainty, and it's probably slightly pro-inflationary.
All right. Well, I'm gonna leave it at that. Give you the last word there, John. Thank you to everybody for tuning in. Thank you to John Leer. Again, he's the chief economist at Morning Consult. They generate some fantastic research. I definitely use a lot of it. He's also part of a sort of a pioneering research group with the Cleveland Fed that developed a really cool new approach to consumer inflation expectations. Check that out. Thank you to Allison Schrager, our Bloomberg opinion columnist, senior fellow at the Manhattan Institute. and author of An Economist Walks into a Brothel and Other Unexpected Places to Understand Risk. Your inflation report today from the Bureau of Labor Statistics gave you core inflation up just 0.1% month on month, which left your year on year at 3.3%. So let that sink in for a little while and have a great day.
Thank you.